This house in Tacoma, Washington is listed at $509,000, and we're going to talk about what it would look like to buy this house if you have $100,000 saved up. We're going to look at a mortgage quote to talk about how much your monthly payment might be, how much cash you would need to bring all in order to close the deal between your down payment plus any other closing costs you're going to need to bring. And then we're going to talk about how much income it would take to qualify for the loan in this scenario. And then at the end, I'm going to explain a concept that I think is really important for you to understand before you go get a mortgage to protect yourself. This is a very confusing industry, and there's one concept in particular that I think is really important to protect yourself, to make sure you're getting an accurate, honest quote and know what you're getting into. So I'll explain that at the end as well. This is a real mortgage quote that we're going to be looking at. My name is Landon Buteau. I work with Cleveland Street Mortgage, a mortgage broker based in Bothell, Washington. And so this is a real quote that we would pull on the house. It's not the exact numbers you're going to see. The interest rate isn't the exact interest rate you'll get. It's not an advertisement, but it should get you a really good idea of what to expect with reliable numbers, more so than you might get on Zillow, as well as a little bit of an explanation behind why the numbers are what they are. So let's go ahead and look at the quote. All right, here's the quote, and you can see I've actually created two different quotes, two different scenarios. And the reason for that is I got a comment on a recent video requesting that I show a 3% down, a minimum down payment situation. Like, what's the minimum I could bring and what would that look like on my mortgage versus what's a more ideal scenario. So this one on the right is actually 16% down, and this is the one where you have $100,000 to bring cash all in, whereas this one is actually a 3% down scenario, which the minimum down payment that you're able to bring depends on a lot of different things, but typically 3% down is the lowest conventional loan, is the minimum down payment you can bring for a conventional loan. So that's what we're using over here. This is a bad 6. It looks like a 10. So 16% down. And I do apologize, just my penmanship is not great. In order to create this quote, I had to assume a specific credit score. So I'm assuming credit score of 740, which will impact your pricing. Your credit score does impact your pricing. However, if you are in the 700s, if you're kind of close to this, then your credit's probably not, your mortgage payment and all this is not going to be drastically different. If you're somewhere in that 700s, probably. It has a real impact. The higher your credit score, typically it improves your pricing. The lower your credit score, it hurts your pricing. It has a real impact. But if you're relatively close to this, if you're in the 700s, it's not going to be drastically different. So let's walk through. What I'm going to do is I'm going to walk through the $100,000 scenario on the right, the 16% down scenario on the right, and I'll explain what your monthly payment would look like and all that. We'll walk through a quote, and then I'm going to walk back through this 3% down and show you how it would be different. So the 16% down scenario, here's your monthly payment, $3,525. Now, how do we get there? Why is that number what it is? These two components are functions of the house: homeowner's insurance and taxes. Homeowner's insurance, we're estimating $150 per month. That is an estimate. It's a rough estimate, but it's a pretty average number for what we see come through on this price point in this area. That's going to depend on where you're located, what costs homeowner's insurance look like in your area. It's going to depend on who your provider is, what their pricing is, and how much you're getting covered. So it's going to vary a lot, but 150 is a pretty good estimate for what we see commonly come through. Taxes, this is the actual number drawn from the county website, Pierce County for Tacoma, which is $381 for 2024, is $381 per month on this property. These are included in your mortgage payments typically. There are exceptions to that. If you're really curious, you can look that up. There are exceptions sometimes to being able to pay those on your own, but typically these are included in your mortgage payment. Now, mortgage insurance of $36 per month. Mortgage insurance is a cost you have to pay if you are putting less than 20% down. And the reason for that is it's required across the board. It's universal. And the reason for that is it protects the lender from the possibility of default on your mortgage. So if you put less than 20% down, you're obviously a higher risk of default. So this will protect the lender. Now, I said it's universal. You can look into some possible exceptions, but just almost universally, if you put less than 20% down, you're going to have to pay some mortgage insurance. This number is pretty low for mortgage insurance, and mortgage insurance is affected by several things. One of those things is your credit score. That has a significant impact on what your mortgage insurance is. Another is just how big the loan amount is, and then another is what percentage down you're putting. If you're only putting 3% or 5% down, then it's going to be significantly lower or higher mortgage insurance. But we're almost at 20 here, and especially once you hit 15% down, then that bumps you into the next threshold where they can tell that you're not going to be a massive risk, and so it reduces your mortgage insurance. Principal and interest of $2,959. Now, if you're curious why we're doing 16%, I'll touch on that in a second. It's kind of an odd number, but it has to do with our having $100,000 saved up. So this principal and interest is a function of your loan amount and your interest rate. The loan amount that's left over is $428,358. That's what we have to pay off, and the interest rate is 7.375%. Now, that's higher than it has been the last several weeks, but that's just kind of where we're at right now, low sevens, and market took a hit over the last week or two, and we're even a little bit higher now. I don't know what to expect going forward. Again, this is not the exact interest rate you're going to get. This is not an advertisement for the rate, but it is just a good estimate of where we're at, starting to near the end of April. I guess we're still mid-April is when I'm making this video, so it is a good estimate for where we're at right now, 7.375. Now, this is an important section that I am going to come back and explain a little bit more later, how this works, points or credit. And this is the section I was talking about earlier where you need to be really aware, because some loan officers and lenders can take advantage of kind of confusing you in this area, or just advertising rates that aren't fully honest in this area. So we'll come back and talk about that. But basically, points are a fee you can pay up front in order to get a lower interest rate. And credit is the reverse of that, where you take a credit towards your closing costs and you tell the lender, I'll take a higher interest rate if you cover some of my closing costs. In this scenario, we're technically paying $784 in points. Again, I will come back and explain why that is, what it is later, and how to think through that. But what you need to know for now is this number could be $20,000, $30,000, $40,000. It could be a very high number, and even at that point, the interest rate would still be in the high fives, maybe mid fives, if you're paying that much in points. So this number is very, very close to zero relative to what it could be in order to make an impact on your interest rate. So you're really not having much of an impact with this number. I'll explain why it's not zero later. Other closing costs, $11,224. Now, this is why we're doing 16% down, because we're assuming we have $100,000 to bring to the table, and on top of your down payment, you have to pay closing costs. You can't just come and get a house, come and get a loan, and expect not to pay costs. There are closing costs involved, and I'm not going to get into a ton of detail right now, but closing costs include two general components. One of just the cost to get a loan, the cost to get the house, paying parties that are involved to help make that happen. And then the other is what's called prepaids, which are costs that you will be paying on an ongoing basis as part of your mortgage, but you have to get some of those into escrow ahead of time. And that's just where I'll leave it. Those are the two components of closing costs. We're seeing $11,224 right now. It depends on several things. Two of the key things are what your loan amount is and what your purchase price is. Both of those impact what your closing costs will be significantly. So for our area, this is a relatively low purchase price and could be a significantly higher loan amount. And so $10,000 to $12,000 for this loan amount and purchase price is pretty reasonable to expect. Any higher in either of those categories, and that could easily be closer to $12,000 to $15,000 of closing costs. So what that means is we have our closing costs of $11,200 and our down payment, and we have to cover all of that with $100,000. So if we went to any higher than 16% down, we would have been over $100,000. So that's why I chose 16% down, because the 16% down payment plus our closing costs put us at $94,710. Now, if you want, if that's helpful to you and you just want to skip to what your, let's see, what am I doing next? If you just want to skip to how much income it would take to qualify for it, you can skip to that. I'll talk about that down here. I'll try and put chapters in so you can skip to that. I'm going to walk through now the 3% down and show you how it's different from the 16% down beyond just the larger loan amount. So these are going to be the same right here, homeowners insurance and taxes, because those are both dependent on the house and not the loan structure. Mortgage insurance is going to be significantly impacted because it's a much lower down payment percentage and much larger loan amount. So now we're at $148 per month of mortgage insurance. Still, compared to what you might find out there, this could be pretty low. Our lender tends to offer pretty good mortgage insurance, and then we're in a specific loan program that is offering pretty good mortgage insurance right now. That's what I'm using right now. It's not like each lender just has one rate of mortgage insurance. It depends on a lot of different things, and the loan program that I'm using is assuming you have you meet certain income standards and you are a first-time home buyer, which gets you into this loan program that I'm using, which offers good mortgage insurance. Principal and interest is the last component here, $34.16, which again is a function of your loan amount, which is now $494,652, and your interest rate, which is the same. In this case, your interest rate was not significantly impacted by the fact that you had a higher down payment. Not in this loan program, not given the rest of the profile. Sometimes if you make it from 3% to 10%, 10% to 15%, your interest rate could change. Typically, the things that are going to change the most there are your mortgage insurance. If you make it up to 20, especially 25%, you might be able to get a better interest rate there. Again, points or credit, I will come back and explain what's going on there, but again, a relatively low number. We're not really paying a lot of points to get this interest rate. And then closing costs, slightly higher because your loan amount is higher. So $11,439, and then estimated cash to close, that is your 3% down payment plus your $11,439 of closing costs, means cash all in that you'd have to bring to the deal available would be just under $30,000. All right, let's talk about income. How much income would it take to qualify for the loan in each scenario? And this is where it's helpful to see what extra cash could do for you. So I will walk through each scenario here. How much income would it take to qualify for this versus this, 16% down? And then after we walk through that, we'll come back and talk through the points. So the way lenders determine whether you can qualify for a loan is they look at what's called your debt-to-income ratio, your DTI, debt-to-income ratio. And your debt-to-income ratio is your total monthly debts divided by your gross monthly income. Your total monthly debts, this number here is your new proposed housing payment that you want to try and take on, plus any other monthly debts you have, credit card, student loan, car debt, any other monthly debts you have, all added together with your new housing payment. And they divide that by your gross monthly income, which is your income before taxes. And if this number is less than 50%, then for the most part with a conventional loan, lenders will let you take on the loan. You will qualify for the loan. Now, that is specifically true of conventional versus other loan types. Conventional, FHA is very similar, but the calculation is the same, but the number used is slightly different. But for the most part, if you're using this to calculate, it's very similar. You can look up what the difference is another time. I'm not going to get into that now. And then VA is pretty significantly different, so that doesn't really follow here. How they determine what you qualify for VA is pretty different. Now, two important notes here. One note is I am not talking about how much you can afford. I'm not giving you financial advice. I'm not telling you that your monthly payment you can comfortably have your monthly payment be 50% of your total income and be happy with that, and that's good financial. That's not what I'm saying. What I'm saying is, if you came to a lender with X amount of income, would they let you take on the loan? So bear that in mind. You can decide for yourself what you're comfortable with budgeting wise. The other important factor is that this number here, gross monthly income, is the income in the eyes of the lender. It's not the income that you are necessarily using to budget on your own. Like, how is this number determined? If you are heavily commissioned, if you work variable hours. Okay, so if you are salary, this number is pretty easy to determine. If you're almost entirely salary or entirely salary, this number is pretty easy to determine. They generally just use your salary, and that's usually pretty easy to use. However, if you are other types of income, you work variable hours, you're mostly commission, you get paid in stock or whatever, or if you're self-employed, the way that this number is determined, your income has to meet pretty strict rules that the lender works by in order to count it towards this number. So even though you're going to make $100,000 this year, the lender might look at that and say, no, we can't use any of that for this number here, because if you only had that job 1 year and you don't have any history showing that, and there's no guarantee that you're going to make that money if you're all commission or if you just started this new business. So the way that this number is determined, if you're in any of those other boats, it has to meet pretty strict rules, which you can look into in another video. But just be aware of that the number I'm going to be using down here is assuming that it does qualify in the eyes of the lender. So if this rule is true, if your total monthly payment has to be no more than 50% of your gross monthly income, then this number, in this scenario here, for the $4,095 monthly payment, would then have to be $8,190 per month. You have to be making $8,190 per month in order to qualify. Again, I'm not telling you affordability or budgeting rules. $8,190 per month in order to qualify. That's what this number needs to be. And that is assuming you don't have any other debts. If you have other debts, you just have to add that to this number up here and then divide by your income and see if it's less than 50%. But this is assuming you don't have any other monthly debts. Annually, that would be $98,280, I think. If I can read my penmanship right. Okay, so $98,280 per year. Now, this is why it's going to be helpful if you can bring a little bit more cash, because this scenario over here, since it's only $3,525 per month, it's going to be $7,050 per month of qualifying income that it would take to qualify for this loan, or $84,600 per month. And if you are buying with your spouse, then that income can typically be combined. It can be your combined income that needs to be this number. And that's another scenario where it's helpful to understand this rule, is if you're buying with your spouse and your spouse is fully salaried, but you've been doing this commission deal for just under a year, and you're comfortable with your income, but the lender won't count it, maybe you can qualify just using your spouse's income because they're fully salaried. So that's where it's helpful to know that. All right, so if you were to go and get a quote and see if you could qualify for a house that looked like this in the Tacoma area or just greater Seattle area, whatever, it's very important that you understand this concept of points or credit to protect yourself and make sure you know what you're getting into. Because you might be comparing lenders, you might be shopping lenders and wondering who has the lowest interest rate. And you might see one lender who shows you a quote or who says, I can give you a 6.5 interest rate right now. And the other lender says, I'm at 7.375. And you're like, that's an easy choice. Well, it's important to know what's going on with this number here with those interest rates. Because this lender might be saying, yeah, I'm at 7.375, no points, $0 in points. Whereas this guy could be saying, I'm at 6.5, but you have to pay $15,000 in points. That number would then be added to your closing costs. That you're going to have to bring that out to the deal. You're going to have to pay $15,000 up front just to get that interest rate. And so it's important to understand how points work. So we're going to look at how a lender prices their rates every day. You can see on this sheet, this is United Wholesale Mortgage's interest rate sheet for April 16th, 2024. And again, none of these are advertisements, but this is what they're showing right now. And it should give you an idea of how rates work. You can see, let's say that you qualify for this program over here, conventional, elite, 21 to 30 years. So 30-year conventional mortgage. Elite just means they have elite program is designed for borrowers with 700 plus credit scores, LTVs of 80% or less, and loan amounts greater than $125,000. Okay, so if all that's true of you, you might be able to get elite. Each loan program has tons of different interest rates available on any given day, but each interest rate, it corresponds to a certain amount of credit or a certain amount of points. So in this scenario, if you qualify for this loan program, the 0 points option would be somewhere around 6.875 to 6.75. Okay, so that's 0 points. Sorry, that's a 15-day lock. This is 30-day lock. Okay, so somewhere, what points are is they are a percentage of your loan amount. So this means you would have to pay 0.557% of your loan amount in order to get this interest rate of 6.75. And then this one, you would take a credit of 0.047% in order to get an interest rate of 6.875. So that's the way interest rates and points work. So these are showing how much you'd have to pay in points or how much of a credit you could take in order to get this interest rate. Now, so that's just something you should be aware of when you look at a quote from a lender. Are they charging you in points? Is that interest rate 0 points, or how many points does it take to get that interest rate? What's the real cost in order to get that? If you do want to get a look at how much you could qualify for, have a look at your income to see how much house you could qualify for, or if you want to get a quote on a house that you are looking at right now, please feel free to reach out. Again, my name is Landon Buto, and I work with Cleveland Street Mortgage. We are based in Bothell, Washington, but we work in Washington and Idaho. We love working with new clients. My dad is the designated broker and owner at our company. He's been doing this for almost 30 years and has a ton of experience. And he's involved in every loan that comes to Cleveland Street and brings his experience to every loan. You can check out our website for reviews to see what other people's experiences have been like working with us. We have a video of what our process is like linked in the description below. And if that looks like it would be a good fit for you, please do reach out.